Group member is Ryan Cobb, and we are Craft Crate, here to present the results of our venture capital simulation. So the first element of this simulation was we were approached by Picaroon's Traditional Ales after our presentation, and with the idea of a strategic partnership. This partnership would entail us incorporating one Picaroon's product in every crate we send out for the first year in exchange for space for packaging and distribution provided by Picaroon's. This would benefit both companies greatly, as we would have startup space to be able to get on our feet and get to the market as quickly as possible, while using our funding received from the investment to set up other aspects of the company. This will also benefit Picaroon's, as it will allow them free marketing distribution in areas where they might not currently be operating.
So when doing the investment process, one of a very important thing to do is to determine the valuation of your company. So this way, when you receive offers from other investors, you can gauge whether or not these offers are reasonable and whether you should accept them or not. So what we did is we used the venture capital method. So for that, we decided that the investment time would be approximately 6 years, which is about in the ballpark for venture capital investors. And for a metric, we use the enterprise value to EBITDA ratio, which we found to be about 30% based on similar values for what was typical in the industry. And then to determine the EBITDA, what we did is we looked at approximately how much beers Canadians consume every year, which happens to be 23 million hectoliters, and 12% of that beer is craft beer. The average price for craft beer is about $6.50 per liter, and we expect to have about a 10% profit margin. This means that profits from the sale of Canadian craft beer is about $800 million a year. And with that, we can set up a success scenario forecast table. Since we're just a new startup, we have to put in a failure possibility, and the probability of that happening is quite high, so we set that up as 45%. And then in decreasing probability, we go up in terms of performance. So for an excellent performance, we expect to get a 4% market penetration with a 5% probability. And the EBITDA for that case would be of $7.2 million. And then you weight all these possibilities out, and you can calculate the continuing value, which is 20.4 million, and for a rate of return of 40%, which is what venture capital should be at least aiming for as a minimum. We find a valuation of $2.7 million. Then what we did is we contacted Cas Ventures, and we started negotiating with them. First, they offered $3 million for 30%, and we managed to bring that down to $3 million for 27% for year one, and a future option at $3 million for 12%. Based on their offer, the post-money valuation they have is of $11.1 million, which is way higher than what we calculated.
So, judging the overall performance of the simulation, we think we fared very well. We were able to get a large sum of money, make way more than we initially asked for, while still maintaining a large chunk of ownership of our company. For the same value, for same percentage of the company, we believe that an investment of $730,000 on the part of the investor would be equal to our initial valuation compared to their valuation. So, since we fared so well in the investment phase, several aspects were added to the term sheet to compensate for the pain that the investors might feel later on. This includes the full ratchet element, which is if the value of our shares goes down in the future, they are able to spread out their shares to maintain the same value at the cost of a larger ownership of the company. And if we are to sell more shares in the future, they have preemptive rights and are able to get more shares to maintain the same ownership, which could scare away future investors, as this company, Cas Ventures, will likely potentially have a large share of our company. So what we learned from this simulation is that valuing a company in the seed startup phase is very difficult. We came up with a very different number from what our investors came up with, which led to this discrepancy in investment. We also feel like we went to a very inappropriate investor for what we're seeking. Angel investors would have been much more appropriate. as they operate with the sums of money that are more akin to what we need and have a more hands-on approach when it comes to seed and startup companies like ourselves. So if we were to do this again or in real life, we would likely work on having a better minimum viable product to bring to the table. We would be looking for angel investors from the start, and we would likely get a lawyer on hand once setting up the term sheet. So that concludes our presentation. Thank you very much.